Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Monday, March 9, 2015. You're looking at a daily chart of the SPY, and if you'll notice this purple line going across here, I have dual purposes for that line. So let me just get right off the bat and explain that. So if we date back, since we are or should be inside of a weekly top, meaning we should see downward pressure on the market for another week or two, okay? What I'm doing is drawing in this purple line is going to be the line in the sand for what we'll call a pivot to where the market is going to remain in a bearish stance or potentially get more bullish and make higher prices. So here's where that line comes in. And I'm going over to the hourly chart, okay, because I want you to notice where this line is. And this line comes from what could be, or made an argument that is, a head and shoulders pattern on the 60-minute chart, or hourly chart. This would be a left shoulder, this would be a head, and this would be a right shoulder. And this is the neckline that we broke on Friday if this pattern were to be valid. Now, the way that this becomes invalidated is if we should close hourly above this purple line or above this trend line, okay? If we stay below this trend line, what happens is the head and shoulders pattern, if it was activated and we stay below this line, the target price becomes right around 205 and a half, 205.75, in that neighborhood. And where do you derive that target price from? Well, I'm going to show you. You take the high, okay, which is up here, all right? The high was 212.24, okay? And you take the low of, or where the neckline intercepts with that day, okay, and you get about 208.88, okay? You take the difference and then you subtract it from the neckline and you come out with about 205, I think it was 65 or 75, something like that. Anyway, what happens is if that were to play out like that, you should see the market down here really long before, well, you have to see it before it closes above this line, but, you know, should you tag this line and maybe decline again, it could happen that way, or we could just jump right over it tomorrow morning. Anything's possible. The problem with head and shoulders patterns is that too many people talk about them, too many people notice them, therefore too many people essentially try and jump the gun knowing that once it plays out it's going to reverse back the other way, and it really negates, or it almost impacts the validity of the pattern, and it keeps it from playing out. Or maybe it's some other force that the reason that happens, but nevertheless, the more they talk about it, the more it's less apt to happen. Now, I haven't heard a lot of discussion on this, but if they start to talk about it on TV, you can forget it. It's wiped off the table. Okay, so let's look at a couple of other things. Let's look at the IWM, which we haven't looked at in a few days. And I just wanted to show you that in terms of the IWM today, it was actually a little bit stronger than the S&P, yet weaker than the Dow. The Dow was the strong horse today, up about 0.75%. And what that normally means is that money is shifting a little bit towards some of the big, stodgy industrial companies, or Dow-related companies. They're not all industrials anymore. But what that tells you is money's kind of going to hide a little bit. If we saw a rise in the NASDAQ and a rise in the S&P and a rise in the IWM more than the Dow, then I would say money was going into risk assets. But yeah, they're still going into stocks, but they're less risky in terms of the Dow. So I thought I would just bring that to everybody's attention. Another index I want to take a look at tonight is the JNK. We don't talk about this one all that much, but I just wanted to show you, and I'm going to show you a little bit longer term. I want to show you the daily chart, and you can see where this is going down similar to the S&P, only it was down again today, only 3 cents, so you don't make anything out of it. But we are into some support, okay, in this area here. You see this is support, and this pivot here is support. So we are into some support, But any more weakness in the market should bring the JNK down, and any weakness in the JNK should bring the market down, or it should be a tell that the market's coming down. Now remember what the JNK represents. It's junk bonds, high yielding debt, and there's still a lot of high yielding debt that has to come due in the oil patch from a couple of months ago when oil collapsed, or a few months ago when oil began to collapse. You saw the JNK start to sell off down here because there's a lot of high yield debt that won't be able to be repaid. Now that hasn't come home to roost yet, but it will, and you have to keep your eye on the JNK because it's going to tell you long before that those things come home to roost. You're going to see this index start to melt away, so it's something you want to keep your eye on. One other thing that's important is Intel, and check this out. So Intel has been weak, okay, relative to the market, all right? So relative strength means how's it performing against the broader index, and Intel has been relatively weak against the broader index. Now, let's look at a weekly chart even better yet. Okay, you can see where when this came down heavy on heavy volume, now it's just going sideways and it can't get out of its own way. It came into the 50-week moving average, and should we bust below that 50-week moving average, there's lower prices. And the reason I bring this up is because the semiconductors are extremely important to the overall market. So how do we gauge that? There's a ETF called SMH, which is the Market Vector Semiconductor ETF, and this is basically a basket of semiconductor stocks. And let's go back over to the daily chart. And again, we want to see what's going on here in terms of the semiconductors, and again, we're seeing some weakness, so it kind of did roll over again, but now you're still inside of this area here. So until you can close below 56.15, okay, whoops, where did you close today? 56.48. Okay, so unless you close below 56.15, this will hold up a little bit, but if you close below there, you probably go right down to the 50-period moving average. And it's just another indicator that I watch with the markets. Usually when the semiconductors are weak, it's usually a sign that the market, the underpinnings of the market, are weak relative to the broader market, or the semis are weak relative to the broader market. Therefore, it's an indicator the broader market is weak overall. Okay, so, all right, let's move on real quick, and let's talk about crude oil. And I'm going to bring up the crude oil chart, and what we have here is nothing. You basically have more sideways, directionless trading in crude oil. But what I can tell you is there's a high probability, or in my work, a high likelihood that crude oil sometime tomorrow, and it could happen, before the market opens, it could happen at any point in time, could happen overnight, but at some point tomorrow, I believe crude's going to be back over $51 a barrel again. That's not to say it's going to stay there. I don't have anything beyond that. I just have, I have $51 plus, okay, meaning it's at minimum of $51 at some point on Tuesday. And so we'll see, but that doesn't tell us anything. We really can't crude can't get out of its own way, and I don't see it getting above these highs here at about $55. So look for it to be in this range for a while, and once it breaks out of this range, we'll know it when we see it, because it'll either bust through the top side or the bottom side, and once you do, there should be pressure either way once it breaks out of this range. The longer it consolidates in this range, the more pronounced the move out of this range probably will be. Okay, so we just have to buy our time and wait for crude to tell us which way it's going to go. And at that point, we take the highest probability, which would be in the trend direction of it breaking out of this range, and we'll be able to put on a trade on with that. Let's go over to gold. And gold needs to get off its horse, okay? Here we are. We had a huge down day on Friday, but we're still in that zone where seasonality, we should see an up move for gold, and it's got to get up off its horse this week. It's got to get up off the mat real quick. In fact, it should get up off the mat hopefully tomorrow, and hopefully we'll see some higher prices. But the intraday activity has not been good, so we're looking for gold to kind of change its complexion over the next couple of days. what we've been seeing, let me go over to the even the shorter time frame, the 10-minute. Oh, you can't see it on you see it on GLD. What you see is, I'm going to zoom out a little bit, and you'll see what I'm talking about. Okay, you're seeing, well, let's go back to the 60 on GLD. And here, so we see these up moves in the early in the day, and then it sells off. We see an up move, it sells off. We see an up move, it sells off. And we've seen this stair-step pattern play out over the last, ever since the 22nd, for the most part, of January. And we basically stair-step lower. And until this chart, or until gold can kind of clean up its act and change the way it's trading throughout the day, meaning up early, down late, once we see a reversal in that, it'll be a change in complexity, a change in complexion of gold, and then we should see some upward momentum, because we should be in the zone for upward prices in gold. Okay, I'm going to talk about one or two other things, and then we'll give it a wrap. Basically, the bond market, we'll talk about TLT, bounced off the bottom, big down day on Friday. Let's get the daily chart up here. And we had a little bit of a recovery today, and we still have a long way to go to recover those losses from Friday. But, like I've been saying, you have to look at the bigger picture. And, oh, by the way, where are we? Remember my 124.24? Well, we jumped right over that today, and we stayed above there for most of the day today, 124.24. In fact, let's bring it down a little bit to the daily level. I'll even bring it to the hourly. 124.24 is right here. We jumped over it and stayed above there all day, and that was my level off the weekly chart. Whoops, that's daily. Off the weekly chart, okay, that was a Fibonacci retracement, and it was also a pivot high. Okay, so 124.24 was this pivot high here, and it was a Fibonacci retracement, and I think that low should be good for at least a bounce. And that was my ultimate downside target for weeks and weeks ago, and we finally got there and satisfied that target, even surpassed it a little bit. But let's go to the dollar, and then we'll give it a wrap. And the reason I want to talk about the dollar is, and there's a reason for this line in here, I'll show it to you in a minute. The reason I want to talk about the dollar is because the dollar's been on a relentless, all-out assault on higher prices, okay? And what you have here, and even if you zoom out to a monthly chart, okay, what you have here is just a relentless move, and here's where that line comes in, okay? So you have a pretty solid pivot high here, and I drew this line across because that should provide a good level of resistance. And the reason why this downsloping line exists is because this was the area when you factor in, and these highs aren't exact because you don't know whether it's from the high of the day, the close of the day, the pivot high, which pivot high. It's just a general ballpark area. But when you get down to this area, okay, this was the breakout. So the reason I draw that in is this, okay, I think you have a good chance to get up to this pivot high before the dollar pulls back, and that's going to be right at 99. Let's say 99.30, 99.40, 99.50, and then I think it needs to pull back because remember home base, the red trend line here is the 20-period moving average. You are so far extended from home base that the market just needs to come back home. There's just no two ways about it. And the fact that the media has been ultra bullish of late, relentless up move on the dollar. Dollar's going to keep going higher, listing all kinds of prices. The euro's going to go into zero. The whole 9 yards. This is the point in which we should look for a reversal to occur, at least for a corrective move, setting up the chart for higher prices. Because I think the dollar, you will ultimately get somewhere in this area here, 104, 105, 106, maybe as high as this pivot high here at 108. Okay, that's not out of the question, but it's going to take some time, and it doesn't have to get there all in one shot. And you've been up for like 9 months in a row. 9 months, 10 months in a row is a really long move, and it's going to need to pull back. But on a pullback, the dollar can be bought, and the dollar can be bought for higher prices into either late this year or maybe even as far out as early next year before it ultimately reverses down one more time. Okay, I think we're going to wrap it there tonight. Hopefully it's been helpful. I'm David Frost of MyStrategicForecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.